Hello, and welcome to this week's episode of Coinscrum Markets. I'm Nisa Ammous. Coming up, I'll be joined by Kraken's Pete Rizzo and Fidelity's Ria Butaria to discuss their reports. Philipp Kallerhoff will be looking at hash rate futures in this week's crypto RFQ. Teana's been speaking to Saifedean Ammous about the Bitcoin standard, and Philip Gradwell from Chainalysis is back for his regular review of this week's on-chain data. First, a look at this week's blockchain industry news. U.S. exchange Kraken has issued a report with Finery Technology on how the great wealth transfer will fuel the great Bitcoin adoption. Here's a clip from my talk with Pete Rizzo about it. I'm here with Pete Rizzo from Kraken. Thanks so much, Pete, for joining today.
Yeah, happy to be here, digitally, of course.
So you guys just released a great report talking about how over the next several decades, the US will undergo an intergenerational wealth transfer of $68.4 trillion. Millennials aged 24 to 39 and Gen X 40 to 55 could drive 1 trillion or more of wealth into Bitcoin over the next 25 years. So what tools and theories did you use to arrive at this?
Our goal was really to take what I think people have as the vague impression that Bitcoin will be successful in the future and take hard data that we could find to supplement that, right? So we could paint a picture for readers about what the future might look like, right? So we wanted to examine authoritative sources and make estimates and, avoid predictions, right? We really want someone to come into this report, maybe fresh, maybe a little understanding about Bitcoin from what they've heard in the news, and leave with a set of frameworks that they can look at in terms of analyzing what might be the opportunities for them, their family, for their wealth management as it relates to Bitcoin. So I think what the report really achieves is it does a great job of summing up past research related to demographics, as you alluded to, and their interest in Bitcoin, right? So it really builds on a lot of other studies and surveys, as you mentioned, that find that younger demographics tend to be more favorable, have a more favorable outlook for Bitcoin. So then we wanted to apply the lens of Bitcoin's long-term value proposition, which is really, what we think is the store of value, a technology that people would use for savings, and that provides a non-government alternative to money. So, and then we wanted to apply data from, what we know about how generational wealth transfer occurs, right? So when you're thinking about the future, you're thinking about how money might move between assets. One of the things to look at is, we can make some estimates based on how we know, generations interact and transfer wealth, right? So that's inheritance tax, mortality rates, things like that. So the report really paints a picture of, if it is true that millennials and Gen X are more prone to making Bitcoin investments and believing favorably in Bitcoin. And if they are going to inherit this large amount of money from other generations, maybe who are less favorable, and if they do then decide to put some of that money into Bitcoin, what that might do for the Bitcoin market and how in the future, right, what that market looks like.
Anything going on at Kraken that you want to tell us about in terms of your brand building or otherwise?
Sure. So, obviously the big narrative that people have heard a lot about with Kraken is hiring, right? We've got 70 plus job positions opening. We're over 1,100 employees now, all remote, working globally. I've definitely been fortunate to see a lot of my, old sources and friends in the industry, people like Marco Santori, Dan Held, come here and, really start picking up the shovel and building something great. So, yeah, I would definitely say for anyone interested in putting their talents or creativity towards the Bitcoin and cryptocurrency space, definitely consider Kraken. We're hiring, jobs.kraken.com, and I think a wide range of different specialties too, not just technical. So
great,
check it out.
Awesome. Yeah. Well, thanks so much for joining us today. Elsewhere in the news, decentralized blogging is coming to a crypto URL near you thanks to a partnership between Unstoppable Domains and Protocol Labs. ION, Microsoft's decentralized identity system, launches beta on Bitcoin mainnet. The vision for ION is to furnish users with a decentralized identifier that could replace the need for usernames. This could help us all when we forget passwords or are vulnerable to hacking. Wilshire Phoenix is offering a Bitcoin investment trust similar to Grayscale's offering, but at a lower fee of 0.9%. A survey conducted by news website The Tokenist found that 47% of respondents from 17 countries trust Bitcoin over big banks, up from 29% 3 years ago. And Tether, the dominant yet sometimes controversial dollar-backed stablecoin, leapfrogged XRP this week to move into third place in the crypto market cap rankings with over 9 billion of supply in circulation now versus 2 billion at the start of the year. Next up, crypto RFQ. Welcome, Philipp. Thanks for being with us.
Thanks very much for having me.
So why is Protos better exposure to Bitcoin and Ethereum?
Well, Nisa, thanks for the question, of course. So what we do is active trading of Bitcoin and Ethereum, to name two big examples. And the strategy that we apply is a trend following strategy. It's a very well-known strategy. It's one of the biggest hedge fund strategies in the traditional world. And what it does is basically provides exposure into upward markets and cuts down the exposure if markets are falling. And that obviously replicates a call option in a sense. And that obviously worked pretty well in the past of Bitcoin, since you had massive sell-offs and but then at other times rallies that you were able to participate in.
And what are you seeing this week in the markets in terms of difficulty and hash rates?
Yes, good question. I think it's a very interesting week. So, I mean, obviously, Bitcoin price is kind of flatlining around this $9,500 level. And on the flip side of it, the hash rate futures are trading at a similar level. The Q1, for example, next year is trading at 21.4 T at the moment. And if you compare that to the difficulty today, that is about a 56% increase over the next 9 months. So that's basically the expected difficulty increase over the next 9 months. That's what the market is saying. And, that sounds like a very high number, and it is, right? So 9 months, 56%. That means basically the production for the mining companies will drop by that amount over the next 9 months. What's interesting about it is that they have been trading very, very similar. So Bitcoin price up has also resulted in a hash rate going up and vice versa. And we've kind of analyzed this study and analyzed this data. And obviously this is brand new as these hash rate futures have been just introduced a couple of weeks ago by FTX.com. And what we think is interesting is that they do trade so similarly, which makes sense if you think about it, that if the Bitcoin price goes up, it also means that the mining companies have more profit, and that will allow smaller miners or less efficient miners to come in and turn on machines again, and that will drive up the hash rate, right? So there is this direct relationship between the two.
Any predictions you want to make about where you see things going in the next few weeks?
Yeah, so what's interesting, we've seen the difficulty being adjusted yesterday, quite largely, 14% in fact, which is tremendous. And it actually reversed the difficulty steps down, the adjustments the weeks before, after the halving, right? So the halving had the effect that obviously the production was cut in half to the miners. Naturally, a couple of miners had to shut down, and the expectation, of course, was that this would be about 1/3. And in fact, it was only 15%, and that would have been reversed immediately 4 weeks later, right? So what's interesting now is that if the Bitcoin price doesn't go up to the $10,000, $10,500 level, you really need miners at an efficiency or at a operating cost level of 3 cents per kilowatt hour, including operating costs and electricity, which and the average you can think of is more like 5-6 cents. So for some reason, the miners are extremely bullish on the Bitcoin market, apparently. So we think Bitcoin price should appreciate quite in the short term, 4 or 5% in the next couple of days. But of course, That's obviously always the market.
Thank you so much for being with us today, Philipp.
Thanks very much. Thanks for having me, Nisa.
Back in 2018, Associate Professor of Economics at the Lebanese American University, Dr. Saifedean Ammous, published his book, The Bitcoin Standard, a decentralized alternative to central banking. This week, he joined Teana to reflect upon the recent move into the kind of economic environment he had predicted would lead to the wider adoption of Bitcoin as a viable form of hard money, free from central bank manipulation.
Hey, Saif, it's great to see you. Thanks very much for joining us this evening.
Thank you very much for having me. It's a pleasure.
Yeah. So it has been 2 years since you published the Bitcoin Standard, and a lot's happened in that time, obviously. So we'll try and get to some of that. But I think if you wouldn't mind, can you kind of set the stage a little bit for one of the things you're known for is the Austrian Economics part of your thinking. And I think for a number of Bitcoiners who aren't yet aware of the interrelationship between Austrian economics and Bitcoin and how they kind of go hand in hand, can you just give us a little bit of background on that?
Yeah, I think in my book, I argue that basically Austrian economics is the only version of economics in which Bitcoin operates. And I think this, in my mind, explains why among Bitcoiners, knowledge of Austrian economics is far larger than among the general population. Mm-hmm. I think pretty much most people who read about Bitcoin are still at least familiar with the term Austrian economics, and they realize there's a different school of economics out there, even if they may not be very familiar with what the teachings are. But I think the reason for for this is ultimately that all other schools of economics come from what is called the Chartist school, or the state theory of money, in which money is considered the creation of the state. So the state decides what money is, and the state passes a law and it tells you have to pay your taxes with it, and that's the end of that. And if you don't pay your taxes with it, you go to jail, and then you don't have any money. So you have to use the money that the government is going to be mandating. Yeah. That's the state theory of money. And according to that, we need the government. And in fact, one of the main rationales that is given for why we need government is that we need government to provide us with money, because otherwise, the market wouldn't be able to do it. So with Bitcoin, we see a living refutation of that, because we see a global monetary system that is doing billions of dollars worth of cross-border settlement every day, and it doesn't need any government to supervise it or authorize it. And so, I think part of the reason that mainstream economists have been so dismissive of Bitcoin is that it flies in the face of how they would like to understand money, from the aspect of the government control, the state theory of money. And then the second point, why it makes sense in Austrian economics and why it doesn't make sense from a mainstream perspective, is the issue of the limited supply. Mm-hmm. And this is something. This is why I became fascinated with Bitcoin when I first heard about it, because it is something that I had been obsessing about, the question of the money supply. Does the money supply need to grow in an economy? And in my mind, I used to think, there's no good reason why you would want any increase in the money supply. Keep the quantity fixed, and money like that would be better. So, and I'd always looked for arguments that would explain why this would be a bad thing to have a money supply, and was never satisfied. So Bitcoin comes along, and lo and behold, it works. So I can understand why, if your entire worldview in economics is built around the idea that we have to increase the money supply for the economy to function, this might be something that you're going to feel a little bit uncomfortable around and skip over and go read about something else.
Yeah. Well, you've spoken previously about free market non-governmental money and the sound money principle, which, very, very simplified, says that money is the market's choice medium of exchange, right? So the people have to choose it, and obstructs the government's propensity to meddle with the system, right? So from an academic perspective, how complicit do you believe that our academic institutions in the West specifically have been instilled in, or have they been instilling this inflationary-based Keynesian school within our economic and political institutions? Are they the ones that are driving this?
Very. In fact, I'm currently just today, before getting on this call, I was working on my new textbook, Principles of Economics, which is my next big project, in which I'm trying to develop a textbook in economics, accessible and readable to the modern reader, and that communicates what I feel are the most central concepts in economics. And I was just going over one of the most famous and most widely utilized textbooks in universities today, Greg Mankiw's Principles of Economics, and it's absolutely astonishing. I was looking at saving, so I went and I searched through the index for saving, and I was going through all the mentions of saving, and it's like a bizarro world version of reality. It's a completely different world in which saving is just defined completely differently from how accountants, not just common sense and what your grandmother told you about what saving is, but also what your accountant understands the difference between saving and investment. And all these theories are built around this. And I think, if you look at it a little bit critically, rather than looking at it from the position of just deferring to authority, if you try to think about it critically, it's quite clear that there's an answer that they want to arrive at, and they're doing a whole bunch of numerical huffing and puffing in order to be able to arrive at that answer. But if you try to really reason it from first principles and not based on authority, not based on arguments written in books many years ago, I think the reason ultimately what it comes down to is that these books are written to justify state control of money, and that's why Bitcoin is so interesting, because it's.
So given how committed we are already as a society to this modern monetary theory, if it were to fail, does Bitcoin benefit or is it irrelevant?
Yeah, it's an interesting question. I think generally most Bitcoiners tend to think that we're going to win by seeing hyper-Bitcoinization and seeing hyperinflation of the dollar and all the other things. I tend to have, a slightly different perspective in that I think, it's not that hyperinflation is impossible. It is possible, and we're seeing it's constantly happening all over the world in different times and places. But it happens because the government engages in horrific monetary policies. It doesn't happen because of Bitcoin. At least it hasn't happened yet. And I think, on the one hand, I think I'd say that hyperinflation isn't necessarily related to Bitcoin rising. And I think it's in the sense that Bitcoin can rise without there being hyperinflation. And in the other way, we can get hyperinflation completely unrelated to Bitcoin. So I think we need to separate between those two things, because the way that I look at it, Bitcoin can continue to rise in value and can continue to increase in the volume of daily transactions that it conducts internationally around the world. And when it does this, it increases in importance. And it can continue to do this for another 100 years. And at the end of those 100 years, you look back and you find that Bitcoin constitutes, say, 90% of global international money settlement volume. Or Bitcoin is 90% of global cash balances, and all the other currencies in the world are 10%. That can happen, hypothetically speaking. It can happen even without any of the national currencies experiencing hyperinflation. So we could just get, slow growth in national currencies market capitalization with faster growth in Bitcoin, and eventually Bitcoin overtakes them. That's independent of them going through hyperinflation. Having said that, I think if we do go through hyperinflations, I think arguably Bitcoin would be the solution to this in a sense, because Bitcoin provides people with the alternative that if those things happen, you can get your money out of your country, you can use it. So that's, yes, so Bitcoin would benefit from it, but only to the extent that people benefit from Bitcoin.
Well, so Bitcoin growing in importance and the correlation with saving, I think, is really interesting. And I've heard you give a talk previously around, people in that Gen X, Gen Y, Gen Z generation have not necessarily been attuned to saving, and that perhaps that has been because the inflationary value of money means, well, I'm putting this money away today and it's going to be worth far less than it is when I stuck it under my mattress, right? And even though the Bitcoin supply is fixed, it grows in importance and then therefore, holds its value. So let's, understanding that, if I've got that right, if we're on agreement there, let's shift a little bit into what some of the governments are doing. So we've got CBDCs being talked about now, and major central banks looking to experiment with digital forms of fiat. And so, is this a clear admission that they see Bitcoin as a threat, or do they just see this as another opportunity? Are they understanding the technology now and want to get involved? And does Bitcoin benefit or not?
I mean, to be perfectly honest, the way that I see it is we've had central bank digital currencies from before Bitcoin now has existed. Yeah. There's really
digital fiat for sure, right?
Yeah, the majority of national currencies are essentially digital currencies. Yeah. They don't exist physically. And I think this, to be perfectly honest, I haven't spent much time looking into CBDCs, because every time I spend any time looking into it, it's clear that it's essentially vaporware. There's no functional ability that's added on to this. Only in so much as perhaps it might be that the app that will be on your phone is going to be connected directly to the Federal Reserve, bypassing your local bank. But at this point, this is entirely ceremonial. Your local bank's existence is ceremonial. Your local bank is just part of the Federal Reserve. So getting rid of your local bank from the equation isn't that big of a deal. At least, obviously it is a big deal for the bank, but I'm sure they'll be all right. But if you delve deep into the mechanics of how the modern, well, shouldn't say modern, the ancient 20th century monetary system works, the way that money creation happens is that the banks are creating money through credit creation. And so the central bank is constantly trying to make more money and create more money, but it can only do that through more credit creation. And it can't just get credit creation to happen, because we've already reached the point where everybody is up to their eyeballs in debt already. Anybody who earns a cent has securitized it and borrowed against it, and it's been resold and rehypothecated many, many times. So there's just not much more debt you can create in order to keep this system going in that sense. So in that sense, CBDCs might be a solution, in that if they stop, if they turn it into a system where effectively the burr can go more effectively, where the central bank just hands out cash to people directly and then people go spend it, then they should be able to get the inflation that they have been seeking. And
So I don't know if you've seen it, but Fidelity Digital Assets published a report last week surmising that the number of institutional investors in digital assets is growing pretty significantly, actually, as is the number of investors who believe that digital assets should be part of their portfolio. And the numbers seemed higher than really we see in the general media or some of the major commercial banks might lead us to believe the interest is. So if you've seen the report, were you surprised by some of the adoption metrics that they've produced as part of this investor study?
I saw the story, but I didn't dig into the numbers, so I can't really comment much on it, except to say that my
like 36%.
Yeah, my impression is that number is just way too high.
Yeah.
I think maybe you could turn it if one client in an entire bank has maybe this is the way that they're calculating it. One client at a bank has it, so then that bank is counted as part of the banks that are interested. then you could maybe get 36%. But in terms of the total market capitalization, obviously Bitcoin is nowhere near 36%, not even near, we're less than 0.36% at this point. I think Bitcoin might be about 0.2% of global cash balances. And in terms of global investments, probably even less than that. I don't know. I think...
Well, I thought the sentiment numbers were encouraging. So, if the sentiment numbers are accurate and, we're seeing institutional investors identifying and the value proposition is starting to resonate, then maybe those numbers might be more important than the overall number of people that they say are already in. So is it still a positive directional indicator?
For sure. I mean, I think that the interesting thing is that people are definitely hearing about it more and more. I think that as the joke on Twitter goes, Bitcoin's unique and proprietary number go up technology just does the advertising for it. Like if you're an asset manager at this point, you're looking around at assets that are not correlated. You look around at previous performance. Every year, the case continues to get more and more compelling. Even after you get the occasional one very bad year, you still look at it in the long run. The performance is really good. So I think it's only a matter of time before they start asking questions more and more and looking to get into it. But in terms of current volume, I think it's an exaggeration, but it's a good indicator of where we might be headed.
Great. Saif, thank you so much. It was a real pleasure.
Thank you.
Thanks, Teana. Fidelity Digital Assets released their full institutional investors survey this week, providing a health check on how traditional investors' opinions are changing towards Bitcoin and other crypto assets. I spoke to their director of research, Ria Butaria, to discuss their findings and discuss Fidelity's road ahead. Welcome, Ria. Thanks so much for being with us today.
Hi, Nisa. Thank you so much for having me on. It's great to be here.
So your survey of 800 institutions in the US and Europe said that a third of your clients are already allocated to digital assets and that a whopping 80% find something appealing. What percentage of those are pensions and endowments versus crypto hedge funds?
Sure. So what we found was that actually 70% of pensions surveyed find something appealing, about 50% of endowments and foundations, and 100% of crypto hedge funds and venture funds found something appealing about digital assets. And there were multiple characteristics that they could have selected. The top three were that digital assets are uncorrelated, they are an innovative tech play, and they provide high potential upside.
So it's surprising, given the high number of pensions and endowments, that more of them haven't already entered. So,
yeah, definitely.
Some people said that maybe there's some selection bias because these are already clients of Fidelity. Can you address that?
Sure. So what I would say to that is that the survey was actually conducted by Greenwich Associates, which is a well-known third-party data and analytics provider that has experience administering other surveys for big institutions. And our intention in using them was specifically so that we could get unbiased results. We didn't solicit any names to Greenwich Associates, and neither party knew ahead of time whether the investors surveyed were clients of digital assets. I'd also point out that the survey was conducted blind, which means that the respondents actually didn't know who the survey was being conducted for.
Great. The report noted there was a heavier weighting towards Europe versus the US in terms of appeal, 25% to 10%, because of freedom from government intervention as a reason. Why do you think that is?
Yeah, so that was an interesting discrepancy that we noted, was that a greater portion of European investors specifically found that characteristic to be more appealing. So 25% of European investors said that they find the freedom for government intervention characteristic to be appealing versus 10% of US investors. I think one explanation could be the prevalence of negative interest rates in Europe. As a result of that, digital assets like Bitcoin, which don't generate yield, that turns into a feature, not a bug in a negative yield environment. We think another explanation could be that Europeans might feel that the government has created a heavily regulated environment. So the feature that innovation in distributed assets is relatively more independent might be a more attractive property for them.
Interesting. Yeah. What about demand for assets beyond Bitcoin and Ethereum? What are you seeing there?
Yeah, so certainly, crypto hedge funds and venture funds are interested in digital assets beyond Bitcoin and Ethereum. But if you look beyond that, to more institutional investors like pensions, endowments, family offices, financial advisors, and so on, Bitcoin, their interest is heavily focused on Bitcoin since it's the largest and oldest digital asset. It has the most mature infrastructure, including increasing support from legacy institutions.
Mm-hmm. So what about Fidelity's custody business, and what are you seeing in terms of the consolidation in the industry in custody versus what's going on in the spot market or other infrastructure plays on your radar?
Yeah, so to the extent, there could be many reasons for consolidation in the space, to the extent that there's synergies to be had in terms of technology, talent, or client base. Those could certainly be reasons that are driving M&A activity in the space. For Fidelity, we've historically chosen to build businesses in-house and find the right talent with the relevant experience that can really help us build the business from the ground up. And one of the key reasons is that it allows us to control security and risk management, which are two areas that Fidelity at large has placed a great deal of attention on across all of its businesses. But if it was an appropriate client base or a product offering that is complementary to the services we provide, we would continue to remain opportunistic.
Okay. And prime brokerage being all the rage right now, would Fidelity think about getting into lending?
Yeah, so our focus to date has been starting with custody and expanding our trade execution into trade execution, which allows us to provide clients access to multiple pools of liquidity in a capitally efficient way. But we're constantly, looking at our product pipeline and for ways to provide clients different ways to trade in a more capitally efficient way. But right now, the focus is certainly custody and trade execution.
Mm-hmm. Okay. Are you seeing interest in stablecoins, fiat lending, borrowing, et cetera?
Yeah, I think from a broader industry perspective, we've seen explosive growth in stablecoins. We have Fidelity Digital Assets was born out of a research lab. And that at any given time, that lab is evaluating different parts of the industry, and we're continuing to explore and research the space. So we're definitely keeping a pulse on interest in adding support for stablecoins and whether there is interest in lending and borrowing. We're keeping a pulse on that.
You've previously announced some partnerships or investments into mining. Is that something that you see continuing?
So yeah, Fidelity actually started mining Bitcoin in 2013. It started with a really small experiment in one of our offices, and we still have a team within the Fidelity Center for Applied Technology who continues to focus on researching the space and has taken a learn by doing approach since it's such an important component of Bitcoin. And they are continuing to research that aspect of the industry.
And what about DeFi or staking? Are you getting involved in that?
I would once again say that we are continuing to research and evaluate the space and see, keep a pulse on the things that our clients are demanding. But a lot of our product decisions are driven by client demand. So we'll continue to research, continue to keep a pulse on client demand. And yeah.
Any other?
Right now, the focus for Fidelity Digital Assets is custody and then expanding trade execution services and capabilities.
Okay, great. Anything else you want to add about Fidelity or plans for the future?
I mean, I would just reiterate that, we conducted this institutional survey for a second time this year, and we expanded it to European investors this year, and we were really encouraged by the results. We hope that it helps us and the space understand how institutional investors are thinking about digital assets, and what are the gaps that we can help fill. And we look forward to continuing to do that kind of research into the space around institutional investors and the kinds of services and products that they're looking at and might help improve adoption.
Well, we all appreciate the fact that you are putting this research out, and we are excited about the institutional adoption. So thank you so much for being with us today, Ria.
Thank you so much for having me, Nisa.
Next up, Philipp's back with his review of this week's on-chain data in this week's on-chain reaction.
Thanks, Nisa, and welcome to On-Chain Reaction. I'm Philipp Gradwell, the Chief Economist at Chainalysis, here to take you through what's been going on the blockchain. Well, this week, the Bitcoin price, it declined. It headed down to around $9,100 on the 11th of June, and that settled the week at around $9,500. Bitcoin inflows into exchanges have continued to decline. Last week, we saw the lowest 7-day average that we've seen in 6 months. This week, it's been even lower. There's now around 57,000 Bitcoin flowing into exchanges every day. There was a spike in inflows as the price headed down towards $9,000. So it looks like there were people who were heading to sell their Bitcoin before it went through that $9,000 barrier, which we know is a very important psychological level for people who are trading Bitcoin. And even though these Bitcoin balances have continued to build despite these low inflows, there was an increase in outflows the day after that price decline. So on the 12th of June, there was actually a spike in outflows, presumably as people who had actually bought some of that Bitcoin that had suddenly become a bit cheaper, they decided to take their Bitcoin off the exchange. However, overall, Bitcoin balances continue to rise. Tether balances have actually done much the same, continuing to build, though there was an increase in outflows the day after that price fall. Suggests that people who had sold their Bitcoin for Tether as the price went so low decided actually it's time to sit on the side with some Tether instead. When we look at the flows between the different types of exchanges, actually the net flows between them are almost zero. So while there's still Bitcoin going back and forth between, say, crypto to fiat and crypto to crypto exchanges, the flow between those two types is balancing out. That's interesting. It does suggest that traders who are responsible for most of the net flows between different types of exchanges are actually happy with where their portfolio of assets is sitting. They think potentially they're well positioned for what's to come in the market in the coming days and weeks. So overall, after testing 10K this month, the market this week, it tested the 9K level. And at both price levels, people sent their Bitcoin to exchanges to sell. To me, that suggests that Bitcoin is going to stay bouncing around between those two important psychological levels. Now, the people who are trading around the low 9K level, they seem to have taken their Bitcoin off the exchange if they bought Bitcoin at a low price, or if they sold for Tether, they've also taken some of that Tether off the exchange. So those people seem to be like, my trading is done for now, but they are being perhaps overwhelmed by people who are still sending Bitcoin into exchanges, still sending Tether into exchanges. So overall, the selling pressure that comes when you have a buildup of assets on an exchange, that remains. And then the net flows between exchanges, while they're low, and that suggests that traders are happy with their positions and they don't expect big structural changes in prices between exchanges to open up over the coming days, potentially weeks. So I think it's going to stay an unsettled time in the market. And that's it for this week on On-Chain Reaction. Back to Nisa.
Thanks, Philip. You've been watching Coinscrum Markets. See you again next week.